Unfortunately, it doesn't look like winter is the only season that's upon us. It seems to be the time of year when many businesses part ways with employees, and it just happens to be layoff season. And this comes as the tech industry as a whole is seeing a decline in earnings, just as businesses are starting to make plans for the new year. However, the tech folk are also feeling the pinch as well, with layoffs being the first line of defense against a possible economic downturn. It's been going on for a while now, and it's even possible that hundreds of tech professionals will be laid off in the coming weeks. But how much more of that are we actually gonna see? Well, let's find out. Welcome back to Econify. If you haven't subscribed yet, then I don't know what you're doing, but the button is right there. Put a like on our videos and do hit that bell notification icon on your screen. We've seen a lot of layoffs in the past few weeks, from Twitter to Meta to Netflix and many more companies, and it's looking like there's going to be more. Why is that? Well, like I said, you're going to have to find out, so stay tuned and let's get started. Recently, Plaid became the latest US software startup to undergo a huge round of layoffs following a lot of reports that Adobe had begun laying off its workforce out of concern that the soaring inflation could cause the country to slip into recession. Some of the layoffs we've seen at tech streaming giants like Netflix this year have been attributed to the COVID-19 pandemic, while others have been attributed to the massive overhiring during periods of strong growth. Many companies in the tech sector, such as Robinhood, Glossier, and Better, have all announced significant staff reductions for the year 2022. The mass firing of over half of Twitter's staff is arguably the biggest tech industry layoff of 2022. Meta has declared that it's laid off over 11,000 people, and even though Meta stock has dropped by 2/3 in value, the company still plans to lay off 13% of its workers, and even the crypto space isn't left out. Coinbase, a platform for buying and selling cryptocurrencies, revealed that it will be laying off 18% of its staff due to a likely recession, the need to manage costs, and the company's very rapid growth during the bull market. It seems it's not just the big tech guys. There have also been a number of recent layoffs at Vimeo, Shopify, Tesla, Loom, and 7-Eleven. That's the worst one, and a lot more since the beginning of the year. Well, in their public announcements, several businesses have pointed to one of two main reasons. Remember when many people were employed to work during the epidemic, when demand for online services was at an all-time high? Well, that's one of the major reasons we're seeing a massive round of layoffs. Now the e-commerce boom has passed, real-world activity has increased, and the cost of hiring new workers has become sort of too costly. Second, while the economy as a whole has been shaky, corporations have been hesitant to invest in digital advertising, which is a major income driver for the tech industry. The age of easy access to venture capital funding is being brought to an end due to the annoyingly rising interest rates. Over the past few weeks, major technology businesses have posted less than stellar earnings while simultaneously issuing pretty bleak signals about the coming months. Customers were cutting back on spending due to the fear of a recession, and there were no encouraging signs of a turnaround. This means that in the coming weeks and months, those businesses will be looking for ways to save money. And you could say that when businesses need to reduce expenses, wages and marketing are often the first to go. And as a result, the trajectory of ad spending on their platforms usually determines the accuracy of their financial projections. As soon as it starts to seem bad, they have to make changes to the staffing levels to meet customer expectations. In the wake of the pandemic, the tech industry experienced unprecedented expansion. What we're seeing now, however, is the tech industry adjusting to a new normal in which people spend less time indoors with their heads buried in their screens. These numbers and reports have us convinced that now is pretty much the moment to start freaking out. Experts, however, disagree. The economy of the world, and the United States in particular, is undergoing profound shifts. Alterations in consumer behavior were also sparked by the worldwide pandemic. Analytics, though, suggest these fluctuations are typical. These currents move when circumstances throughout the planet require it. Even if we're inclined to trust the experts in the field of finance, there is really no hard proof of a coming economic downturn. As of now, it's just speculation. According to one explanation, a bear market occurs when investors choose to avoid taking risks instead of actively seeking them out. Probably the ramifications of the current era of corporate uncertainty have yet to be fully realized and understood. You could say that we're dealing with a volatile market. Across the United States, this downward trend has spread like wildfire. But what will happen after this? Investment firms in the public and private sectors will almost certainly alter their strategies and priorities. As a result, they will focus on metrics like cash flow and profitability rather than expansion. Still, no credible analysts seem to be anticipating a major disaster in the near future. Some even say that tech will have a long and fruitful existence. Investors have also increased the pressure to reduce expenses, saying that businesses are too bureaucratic and slow to react to economic slowdown. Sir Christopher Hahn, an activist investor, wrote an open letter to Alphabet, the parent company of Google and YouTube, urging the business to reduce employment and compensation. He argued that Alphabet's Waymo, its self-driving car subsidiary, and other endeavors needed stricter cost controls and that corporations as a whole needed to be more frugal. And as with any business, Elon Musk also believes there is space for cost reductions at his most recent investment, Twitter, which has so far failed to generate a profit and get new customers. Many observers believed he paid too much for the company and is now trying very hard to make his investment profitable. He fired over half the staff and now demands some extraordinary productivity from the people still working there. Some US media outlets even reported that Mr. Musk had told employees that they must either join his hardcore culture of long hours at high intensity or to be fired, which is really disappointing. To answer that, yeah, there most likely is. Was there a price bubble? Yeah. Did Meta make too many hires? Probably. But does that explain why they're firing people? No, not so much. To put it simply, Meta is wealthy, and all of these businesses have positive cash flows, and they're just following the lead of competing businesses. Companies rarely save money through layoffs since former employees frequently find work as contractors, with the company paying the contractor rather than the former employee. The stock price of a company rarely rises after a round of layoffs, in part since layoffs can be a warning of trouble. Workers' output does not rise in response to layoffs, and the real issue, which usually results in layoffs, is either an inefficient strategy, a decline in market share, or a lack of revenue. And reducing staff through layoffs is a poor choice overall. Unemployment is lethal to those who experience it. They're deadly in a variety of ways. The risk of suicide, in fact, is increased by a factor of 2.5 after a layoff. Outside the US, this is also true, even in nations that have better social security programs than the US, such as New Zealand. However, they may soon face formidable new rivals. When you think about 2022, where do you suppose the unemployed will look for work? It appears that all of the major IT firms are either laying off workers or not filling open positions. The most obvious option is to join a new company. Those in the startup and investment world looking to develop the next big thing are benefiting from big tech's forced exit. The CEO of an indie game firm, Nick Popovich, recently tweeted, "To everyone affected by the Meta layoffs, Monami Park is recruiting." In response to layoffs in the tech industry, Day One Ventures launched a program that offered to invest $100,000 in 20 startup concepts pitched by former big tech employees. And according to PitchBook, a database for startups, venture capitalists currently have an estimated $290 billion available for investment, indicating a large pool of capital for new business owners to tap into. There has never been a better time to recruit top personnel to help you realize your vision of capitalizing on the upward trajectory of technology. Hundreds of engineers, product managers, and designers have probably been laid off recently, and one can only assume that they are already plotting the launch of new companies based on ideas they have been quietly developing for months while working for companies that are now feeling insecure about their ad-based business models. And that's it, guys. Don't forget to like and subscribe to Econify and let us know your thoughts in the comments below. Thanks for watching as always, and I will see you in the next video.